our previous video, we started looking into the whirlwind of theories surrounding JP Morgan's role in the silver market. Today, we're diving straight into the storm. For years, market watchers have tracked the bank's every move, often pointing to them as a key force in keeping silver prices suppressed. But now, the story that's bubbling up in financial circles is something else entirely. A narrative that almost no one saw coming. You've probably heard the rumors of their colossal, almost unbelievable hoard of physical silver. But the real story, the one that's lighting up trading desks and investment forums, isn't just about the size of the stack. It's about the timing. A theory is gaining ground, pieced together from market data, insider chatter, and questionable filings, that all of the bank's moves are pointing to an explosive event in 2026. This isn't just a story about a bank making a smart bet. It's a gripping theory about how one of the most powerful banks in America may have gotten caught in a trap of its own making. The narrative suggests their frantic escape attempt is about to set off a fire in the silver market that could make today's prices look like a distant memory. Section 1. Anatomy of the Trap. To really get what the buzz is about for 2026, you first have to understand the battle lines. On one side, you have the paper market, a world of derivatives and futures historically dominated by big banks like JP Morgan. On the other, the physical market, real metal, real mints, and real industrial demand. For decades, paper has called the shots on price. According to this theory, that's all about to change. Let's start with the rumor mill's Exhibit A, the hoard. Chatter suggests JP Morgan has accumulated a staggering 750 million ounces of physical silver. To put that into perspective, it's roughly half of what every silver mine on the planet produces in a year. For a bank that many believe built its strategy on keeping the price of this metal down, this looks like a complete 180-degree turn. It seems like they're positioning for a massive bull run, but that might just be the cover story. This brings us to Exhibit B, the alleged bleeding short. For months, one popular narrative was that JP Morgan had finally closed its infamous paper short position. But another more dramatic story has emerged. It's based on a supposed Form 8K filing from December 2025 that has been circulating, which claims the bank is still carrying a massive unrealized loss of $4.875 billion on silver shorts. Let me be clear, the authenticity of this document is highly disputed, but it's the engine driving this cornered animal theory. This narrative claims that the big banks, led by JP Morgan, remained collectively short by over 200 million ounces as of early December 2025. If you believe this theory, they aren't prophets who flipped long, they're trapped shorts. The story goes that as the price surged in 2025, they tried to cover their bets, but the physical market was just too tight. Every attempt to buy back their paper shorts supposedly sent the price screaming higher, making their position even more toxic. In this version of events, their physical hoard isn't a victory flag, it's a life raft, the only thing that can protect them from a catastrophe they created, and let's not forget who we're dealing with. This is the same institution that paid a $920 million fine to the Department of Justice and the CFTC for a massive scheme to manipulate precious metals prices between 2008 and 2016. They have a documented history of using tactics like spoofing to protect their positions. They built this game, and now many believe they're the ones caught in their own trap. Section 2. The market breaks. A trapped short position of this size, even a theoretical one, is only a doomsday machine if the supply of real metal dries up. And that's exactly what market watchers say happened in 2025. The gap between the paper price and physical reality has become a chasm. The first tremor was the great drain of the COMEX vaults. The COMEX is the main exchange where paper contracts are supposedly backed by physical metal. Throughout 2025, a steady drain on these vaults was observed, with reports of registered inventories falling sharply. Think of it like a bank run in slow motion. The owners of paper silver contracts are showing up and saying, "I don't want the paper anymore, give me the metal." And the vaults are being emptied at a startling rate. This isn't just a COMEX story, it's a global one. We saw reports of record-breaking demand from India and announcements from the US Mint about its inability to meet public demand. The message from all corners of the globe was the same. The physical market is starving, and it's losing faith in the paper price. This set the stage for the chaos of late 2025. The price, partly breaking free from years of alleged suppression, began to climb, with silver touching levels not seen in decades. For anyone holding physical silver, it was a monumental win. For any institution heavily short, it would have been a bloodbath. But the system, as always, fought back. Just as the shorts were about to be tested, the CME Group, which runs the COMEX, stepped in. In a move that many traders saw as an act of desperation, they abruptly hiked the margin requirements for the March 2026 silver contract. The cost to hold a single contract jumped from around $22,000 to over $25,000. This instantly forced leveraged long players to either put up more cash or sell their positions, creating a manufactured panic. The price plunged, not because of a change in fundamentals, but because the exchange changed the rules mid-game. Don't misinterpret this. Market analysts argue this wasn't a sign of silver's weakness. It was a sign of the paper market's fragility. They had to pull the emergency brake to prevent an implosion, but all they did was buy a little time. They can't print more physical silver, and the clock is ticking towards 2026. Section 3. The 2026 Endgame. So why 2026? What makes that year the focal point for this entire story? It's a convergence of several powerful catalysts, all lining up in the same window. First, the supply deficit. For 5 straight years, from 2021 through 2025, the world has been consuming more silver than it produces. Each year, we dig deeper into existing stockpiles. By 2026, many believe these accumulated deficits will reach a critical point, leaving above-ground inventory at a historic low. The buffer is gone. Second, and this is a massive catalyst, is the China factor. China, a huge producer and refiner of silver, has seen the writing on the wall. Starting January 1st, 2026, they are implementing significant export restrictions, requiring state-issued licenses for any silver shipments. This move is expected to effectively pull hundreds of millions of ounces of supply from the world market at the exact moment it's needed most. It's the geopolitical equivalent of pouring gasoline on a fire. Third, you have relentless industrial demand. Over half of all silver consumed goes into things like solar panels, EVs, and 5G tech. This isn't investment demand that vanishes when prices rise. It's critical to the modern economy. These industries will likely pay whatever it takes to get the silver they need. Now, let's play this out. What happens when the unstoppable force of global physical demand, supercharged by industrial buying and a Chinese export ban, meets the immovable object of a giant, potentially trapped paper short position? This is the very definition of a market corner. In this scenario, a bank like JP Morgan would have 2 ways out. Option 1, keep trying to buy back the shorts in the open market. But with COMEX vaults draining and China hoarding supply, that's a nightmare. Their own buying would send the price into another dimension, compounding their losses. Option 2 is the nuclear option. They could simply default on their paper contracts. The COMEX price would become meaningless overnight. In that world, the price of silver is no longer set by a paper market in New York. It's set by a mad scramble for any physical metal left. What does that price look like? The mainstream banks are finally catching on. Bank of America raised its 2026 target to $65 per ounce. Other analysts, tracking institutional flows, are projecting prices of $100 or more. In a true default scenario, figures north of $600 per ounce, once considered fantasy, become a mathematical possibility. Let's be clear, this is a market theory, but it's one built on a fascinating foundation. For decades, the silver game was played one way. Now the board is being flipped. The players who held the price down for so long, profiting from suppression, may have gotten too greedy. The theory is that they held their short positions for too long, underestimating the power of a global awakening to the value of real, physical metal. If the narrative holds, their legendary paper short is bleeding them dry, while an unprecedented physical hoard is their only potential salvation. They would be both the villain and the victim of this story. 2026 is shaping up to be a deadline. It's the year structural deficits become critical. It's the year China pulls its metal off the global chessboard. It is the year the decades-long paper game could finally come to an end, where physical reality takes over with a vengeance. If you want to know the key indicators that will signal the final countdown to this 2026 tipping point, make sure you subscribe and hit the bell for notifications. In our next video, we'll break down exactly what to watch for in COMEX reports, international trade data, and the bond market. A massive wealth transfer could be approaching. You won't want to be on the wrong side of it.